Okay, you have got to see this. Headlines screaming trade war 2.0, right? New tariffs, U.S.-China tension heating up again.
Yeah, the usual stuff that makes markets nervous.
Exactly. But then you look at the markets, and it's weird. Stocks are up. Crypto flying. Bitcoin just smashed past $94,000.
It is quite the disconnect, isn't it? Nasdaq's up over 3% too.
Even companies you'd think would be hit, like Tesla and Boeing, they're rallying. Tesla up 5%, Boeing 6%. What is going on?
It's the central puzzle. You've got these renewed trade worries, which normally, sends investors running for cover.
Right.
But instead, we're seeing this broad upswing. Equities, crypto, even some commodities.
So is this real? That's what we're trying to figure out in this deep dive, right? We've looked at the reports, the analysis.
Exactly. The mission is to understand if this is a genuine bullish turnaround. Maybe the market just doesn't care about tariffs anymore.
Or is it one of those nasty bear market rallies? The kind that looks good for a bit and then pulls the rug out.
A bull trap. It lures you in.
Yeah. And look, we know navigating this stuff can feel, well, overwhelming. So we want to try and bring some clarity for you, make sense of these confusing signals.
Okay, so let's break down that core contradiction. On one hand, yes, renewed U.S.-China friction. We're hearing cautious things from CEOs too, guidance being revised down, earnings growth slowing.
All the classic warning signs?
Pretty much. But then, the other hand, Bitcoin surge. You mentioned the ETF inflows, definitely a factor, plus short liquidations pushing it higher.
Right, people betting against it getting squeezed.
Precisely. And Ethereum's had double-digit gains, the Nasdaq climbing, S&P 500 reclaiming levels. It's not insignificant. Even Boeing, as you said, getting a lift.
It's almost like the market's betting against the bad news. But, markets can bounce just because they fell too far too fast, right? Oversold.
That's a very real possibility. Or sometimes it's about perception. Maybe investors see a glimmer of hope, a potential policy shift.
Like back in April, remember those huge 145% tariffs got announced? The market dipped.
It did initially.
But then the Treasury Secretary made some comments, sounded a bit like de-escalation, and boom, the market rallied back.
Exactly. That less bad than feared dynamic can be powerful. Doesn't necessarily mean the underlying problems are gone.
Which brings us to the technicals. Because, the charts do look kind of bullish, don't they?
On the surface, yes. If you look at tools like MACD, RSI, even VWAP on shorter time frames.
Yeah.
They are flashing some green signals.
What's the RSI showing? I heard some big tech names were looking hot.
Yeah, relative strength index readings for some mega caps, and even the broad S&P 500 ETF, SPY, surged above 70.
Okay, wait. Isn't above 70 usually mean overbought, like due for a pullback?
Typically, yes. But, and this is the tricky part in these situations, momentum can carry things further than you'd think, especially if short sellers are being forced to cover. That adds buying pressure. So overbought doesn't always mean an immediate drop, particularly in a potential bear rally.
Ah, okay. And MACD.
We're seeing MACD crossovers confirming that upward push. And VWAP, the volume-weighted average price that's been acting as kind of an intraday floor, providing support, especially around earnings for volatile stocks like SAP and Tesla.
So the technical tools are pointing up, but it feels like there's a big but coming. Is this real strength or just, a setup, the bull trap we mentioned?
That skepticism is crucial. You have to ask that question. Because when you look under the hood at the fundamentals, there are definitely some cracks.
Like what?
Well, for starters, the IMF just revised global growth forecasts downwards. That's not exactly bullish.
No.
And here in the U.S., yeah, the job market's held up okay, but we are seeing signs of slowing job creation and the yield curve.
Still inverted, or partially anyway.
Still partially inverted, yeah. And, historically, that's been a pretty reliable recession warning sign. Plus, manufacturing sentiment is, well, it's pretty subdued.
And we are seeing real-world impacts from the trade stuff, right? Boeing's a perfect example.
Absolutely. They had that pause on orders from China, direct hit. They had to actively go find other buyers for those planes.
And Tesla. Big rally lately, but didn't their earnings take a massive hit?
Huge hit. Quarterly net income dropped, I think it was 71%, even with the CEO trying to refocus amidst his other responsibilities. So yeah, the market rally seems a bit disconnected from that reality.
It's not just us either. Europe's wrestling with this too, isn't it? Trying to handle trade friction without tipping into recession.
Exactly the same tightrope walk. Balancing act between the ECB, national leaders. It's tricky.
So, okay, the takeaway is that these market rebounds can definitely mask what might still be a bear market underneath.
Precisely. It creates this false sense of security, easy to get swept up.
So, for you listening, trying to make sense of this, how do you actually navigate it? What are the strategies?
Right, the practical side. Well, first, understand why these bear rallies happen. Like we said, less bad news, oversold bounces.
Not necessarily fundamental strength.
Not necessarily. And the big danger is mistaking that bounce for the real deal, getting sucked in right before another potential drop.
So, how do you spot a potential trap? Are there signs?
There often are, yeah. Look at trading volume on the way up. Is it strong, broad-based buying? Or is it kind of weak, maybe concentrated in just a few hot stocks?
Okay, weak volume is a red flag.
It can be. Also, look at which sectors are leading. In a real recovery, you usually see leadership from cyclical sectors, industrials, financials, showing real earning strength. If the rally is mostly defensive stocks or just driven by short covering, be wary. Lack of confirmation from those leading sectors is another warning sign.
And given the whole trade war 2.0 backdrop, hedging seems pretty important.
I'd say almost essential right now. You need something in the portfolio to cushion potential shocks. Defensive assets.
Like gold. It hit record highs not long ago, although it's pulled back a bit.
Gold is a classic example. But also think utilities, infrastructure, healthcare, consumer staples, things people need regardless of the economy. These sectors often hold up better when macro stress hits. There was even a report mentioned in our sources, Prologis, talking about U.S. industrial real estate linked to domestic consumption being resilient.
Interesting. What about trying to play the rotations? Like, if tariffs hit one area, does it create an opportunity somewhere else?
It can, yes. Requires being nimble, though. For instance, the sources mentioned tariffs on Chinese rare earths, potentially boosting, say, energy companies involved in alternative mining or recycling.
Makes sense.
Or new U.S. duties on solar panels might help domestic solar firms. Defense stocks often get a bump from geopolitical tension, though that can reverse quickly on peace talks.
You mentioned SAP earlier, too, with bullish technicals. Was that just the chart, or was there more to it?
That seemed like a case where the technicals were backed by pretty resilient fundamentals, strong cloud growth, solid earnings, so not just a chart pattern.
Gotcha. So, for people trading more actively, timing around earnings is key, especially for those high-flying tech stocks.
Absolutely critical for high beta names. You'd look for specific chart setups, maybe an ascending triangle suggesting pressure building, or a bullish engulfing candle indicating strong buying. Then use something like VWAP to see if a post-earnings breakout has real volume behind it, or if it's fizzling out.
Okay, so pulling it all together, the strategy sounds like balance. Don't go all in on the rally, but don't hide completely either.
That seems to be the consensus, a kind of volatility-adjusted, geopolitically hedged approach. Have some exposure to potential cyclical bounces, but keep that defensive core strong.
And don't get married to one outcome. Like,
Yeah.
don't bet the farm on a soft landing or tariffs disappearing overnight.
Exactly. Stay flexible. Rely more on the technical signals, the macro data, how those recession-resistant groups are actually pricing, rather than just a narrative.
Be ready to rotate, maybe even look at unconventional things like crypto if the usual hedges aren't working.
That was mentioned, yeah. Considering asymmetric risk plays if the environment shifts significantly. But the main theme is skepticism. Don't just take the rebound at face value. Question the narrative.
Right. So back to the big question then. Real recovery or just a breather?
And the honest answer is, we don't know for sure yet. It requires constant watching, constant analysis.
So for you listening, keep observing critically. Think about the trade tensions, the economic numbers, how the market's actually reacting sector by sector, all the things we've talked about.
Understanding these dynamics as Trade War 2.0, it's not simple. It requires that nuanced view. Remember, not every jump higher means the storm has passed. Keep watching those signals.